Hello, everybody. Happy Friday again. Taking a short break from filing W-2s to record this video. This one really shouldn't be too long. Um, excuse me. What I wanted to talk about today was um, what, how do I put this without using accountant terms? So when you buy a large item, like a car or a desk actually might not work, but fitness equipment if you're a fitness coach, an expensive computer for video editing, stuff like that. Basically, when you buy a more expensive physical good that you use in your business that is going to last your business longer than a year, or be useful for your business for longer than a year. So that, I mean, like printer paper, you're going to use up right away. Uh, Food, cooking supplies, break room supplies, you use up right away, right? So those, that's not what I'm talking about. I'm talking about like something that a vehicle is a great example, a computer is a great example. These are items. Your cell phone could be an example. These are items that are going to be useful for your business for more than a year. And the basic IRS code for these types of items states that we need to term them as what is called fixed assets or capitalize them and then depreciate them over a certain lifespan based on the type of item it is. For example, a car or a truck has a 5-year class life. Um, Different types of office equipment has 7-year class lives or 3-year class lives or 5-year class lives. Like because semi trucks have a 3-year class life. Land improvements like concrete patio, driveway, stuff like that, that has a 15-year class life. But there, there's a lot of fitness equipment could have a 5 or a 7-year class life. Basically, that's the time we get to take to depreciate it over its lifespan. So if you buy a $50,000 car and it has a 5-year class life, back of the napkin regulations make it the formula way more complicated than this, but back of the napkin math would be that we get to take a $10,000 expense every year for 5 years to get to the $50,000 purchase price. So that is called capitalizing, or buying fixed assets. However, with that being said, the IRS, like literally like a keyboard. You could buy $100 keyboard and technically it should last you more than a year. You could buy a cell phone. It could be a $500 cell phone. It could be a $1,200 cell phone. It's going to hopefully last you more than a year. So basically, what the IRS came out and they said is there's more complicated rules than this, but basically, for most clients, the IRS came out and said, you know what, we don't want you to capitalize to fixed assets and depreciate items of an immaterial value, meaning that keyboard, that $50 or $100 keyboard. So basically, the IRS, and there's different thresholds for different reasons, but for 90% of small businesses out there, the threshold is $2,500. So if you buy anything under $2,500, it's going to get expensed the year you bought it. If you buy anything that's $2,500 or more, it's going to get capitalized and depreciated per IRS regulations based on a lot of different rules. Um, there are some other rules that we could still depreciate it all in the first year and other things. There's a lot of stuff around depreciation regulations that come into play. But basically, what I'm getting at is when you buy something that's less than $2,500, we're going to write it off the year that you bought it. And if you buy something that's $2,500 or more, we're going to capitalize it and depreciate it over the regulated lifespan of whatever item it is. That's the general rule. So I get a lot of questions about, should I keep receipts? Now, disclaimer here, I represent a lot of clients, and so this is what I tell my clients. Don't keep receipts. for the majority of stuff. If we are looking at receipts in an audit, it is a bad day. Everybody's upset. You're getting billed through the roof, and I'm probably going to tell you it's time to hire an attorney to start building a tax defense case against the IRS, right? Because you should have your finances, your business finances should be separate from your personal finance. So that means you have a separate business bank account, and you should be keeping appropriate accounting records, as I've talked about in other videos. So you should have like QuickBooks, Wave, Xero. You're properly coding and classifying your transactions, and you're doing bank reconciliations or credit card reconciliations. So you should have, if you're going to be a corporation, or most small businesses honestly should be S corporations. Like there's a lot of reasons why you should do that, and people will disagree with me, but that's what I think. And if you are going to be a corporation, you have to act like a corporation, or you should act like a corporation. So that means we separate our finances from our personal, from business, and we have properly kept accounting records. Well, with that, I'm going to tell you, if you're going to Office Max, or you're ordering stuff on Amazon or whatever for your business, you really don't need to keep receipts for a whole bunch of stuff that you've bought throughout the year, as long as it's under that $2,500. Now, typically, if you buy something for more than $2,500, there's going to be records of that purchase, because it's a car. You're going to have the loan documents. You're going to be able to go back to Amazon and find your purchase history, or Dell, or Apple, or wherever you're buying this stuff. And typically we buy this stuff on account, or we buy it in a way that it's pretty easy to see what the value of it was when you bought it. For example, a cell phone. A new cell phone is going to be about $1,200. If you're buying Apple, Samsung, or whatever, is going to be a little cheaper. But anyway, it's pretty simple that you don't need receipts for those things. If it's above $2,500, it might be beneficial to at least have it on an account or something, so that you have the record of that. Because typically in an audit, they're going to run what's called materiality. And what do I mean by materiality? I mean that basically in an audit, through statistical analysis, we basically set a limit of stuff that's cheap enough that I'm not going to waste my time looking at it. And so there's going to be a lot of things that you buy for your business that the IRS is just going to kind of lump into one pile of, one or two of these things is going to be immaterial. I'm not going to look at it. And then they're going to want to see potentially receipts or invoices or purchase agreements for some of the larger stuff. And usually that stuff is kept in the tax preparation documentation for the year that you bought it. So that's just something to think about. So that's kind of what I wanted to talk about today. That there is a materiality level. A lot of people ask, what's the receipt? So typically I say $2,500 is the materiality level, because that's the IRS telling us when to capitalize something that you buy. Now, with that being said, it is per unit, not per invoice. So if you bought 10 $1,000 computers, and so you have a $10,000 invoice, each computer is still only $1,000. So we would still expense the entire $10,000 invoice in the year that you bought it. If you bought one $10,000 computer, then we would capitalize and depreciate that. So that's part of that rule there. We are seeing a lot more purchases using things like Affirm. So you buy something online and you put it on a quick payoff program that might last anywhere from a couple weeks to a couple months to 6 months, using some of these short-term loan programs like Affirm. If you're buying something that's more than $2,500, you need to be telling your CPA about it. If it's something less than $2,500 and you're going to have it paid off using this short-term borrowing mechanism like Affirm, maybe you may not need to tell your CPA about it. But basically, anytime you take out a new debt, that could be a credit card, that could be short-term debts like Affirm or PayPal loans or anything like that, or you take out a long-term loan because you bought a house, or you bought a car, or you bought a large piece of equipment, you really should be informing your CPA of that purchase, because it needs to be recorded a certain way on your tax return. and that documentation needs to be kept, because more likely than not, if you are in an audit, that's going to be the documentation that your auditor wants to see. They're not going to want to see your Walmart receipts. They're not going to want to see Home Depot receipts or stuff. And then so a lot of times if you're in a niche industry, you're going to be buying things for your business that come from suppliers of that niche industry. So those things are easy to say too. Like if you're a contractor, you're buying from Home Depot or Lowe's a lot of the time. If you're in the fitness industry, you're probably buying exercise equipment from specific suppliers. So it's the same. Those are easy to show an auditor. Just pull up the website for the company and show it to them, and it's pretty easy. So we don't necessarily need to keep a lot of receipts. We need to keep appropriate accounting records using the materiality level that the IRS has set of $2,500. And then typically we have invoices, receipts, and bought on account for those things. So that's really what I wanted to talk about today. Materiality for less than $2,500 and greater than $2,500. And if you're buying stuff using debt, if you're borrowing money to buy things, these are things that you really need to tell your CPA about. Just shoot them a quick email, or let your bookkeeper know, so that we can make sure we're getting these things coded correctly on the tax return and in your accounting records like QuickBooks. We just see a lot of affirm, and a lot of times it's probably not that material. It's probably a lot of it's probably for stuff that greater than $1,000 but less than $2,500. And so if you just let your CPA know that, or your bookkeeper know that, that would really be beneficial. So anyway, hope this video helps you in better understanding how to type of communication that you should have with your CPA, and help you better understand like documentation, keeping receipts for large purchases. Have a great weekend, and hope everybody is able to make their payroll tax deadline here in a week. Good luck.